Ever wondered how option trading works? Well, let's pull back the curtain and dive into the fascinating world of options. Options trading is like the chess of the financial world. It's all about strategy, and it's a game that's not just for the Wall Street elite. At its core, options trading is a form of investment that allows you to play a more active role in determining your financial future. Now, what exactly is an option? It's a type of derivative security. If you're scratching your head, don't worry, you're not alone. Derivative might sound like a complicated term, but it simply means that an option derives its value from something else, an underlying asset. This could be a stock, an index, a commodity, or even a currency. So an option is essentially a contract, but not just any contract. It's a special kind of contract that gives you the right, but importantly, not the obligation, to buy or sell this underlying asset at a set price on or before a certain date. Here's a simple analogy to help you understand. Imagine you're at an auction. You see a beautiful antique clock that you absolutely love. The auctioneer offers you a special deal. For a small fee, he gives you the right to buy the clock at a set price within the next hour. That's what an option is like. You're not obligated to buy the clock, but you have the right to do so if you choose. Options trading is all about possibilities and potential. It's a versatile tool that can be used for a variety of strategies, from protecting your portfolio against declines to betting on the movement of a market or index. So, now you may be thinking, what does this all mean and how does it work? Well, stick with us to find out. We're just getting started, and there's so much more to explore in the captivating world of options trading. The world of option trading revolves around calls and puts. All right, let's dive into the heart of the matter. Call and put options. These are the two types of options contracts that you can buy or sell. They're like two sides of the same coin, each with their distinct features and uses. Let's start with call options. When you purchase a call option, you're buying the right, but not the obligation, to buy an asset at a predetermined price. This price is also known as the strike price. The catch here is that this right isn't everlasting. It's valid only for a certain period of time, which we call the expiration date. If the market price of the asset rises above the strike price within this time frame, you're in the money. You can buy the asset at a lower price and sell it at the current market price for a profit. However, if the market price doesn't exceed the strike price before the expiration date, the call option becomes worthless. Now let's switch gears and talk about put options. A put option is essentially the opposite of a call option. It gives you the right, but again not the obligation, to sell an asset at a predetermined strike price before the option's expiration date. If the market price of the asset drops below the strike price within this time frame, you're making money. You can buy the asset at the current lower market price and sell it at the higher strike price. Conversely, if the market price doesn't fall below the strike price before the expiration date, the put option will expire worthless. An important thing to note here is that both call and put options carry a premium. This is the cost you pay to buy the option. It's like paying for an insurance policy, and you pay the premium for the potential to make a profit if the market moves in your favor. Remember, options are about the right to buy or sell, not the obligation. That's a huge part of their appeal. So whether you're a bull betting on the market going up with call options, or a bear speculating on a market downturn with put options, there's an option strategy for every market outlook. So we've talked about calls and puts, but what exactly is an options contract? Well, let's imagine an options contract as a kind of triple-layered cake, the layers being the strike price, the expiry date, and the premium. Firstly, let's cut into the strike price. This is the price at which the underlying asset can be bought or sold. Just like picking out the perfect cake, the strike price is agreed upon when the contract is created. It's essentially the price tag you're willing to pay or receive for the asset, be it shares of a company, commodities, or even real estate. Next, we have the expiry date. This is the date when the option expires and the contract is executed. It's the use-by date of our cake metaphor. The expiry date is crucial because it sets a deadline for the buyer to decide whether to exercise the option or let it expire worthless. And keep in mind, once expired, the option can't be revived. It's a one-time deal. Lastly, we have the premium. This is the cost of buying the option contract. It's like paying for the cake before you can enjoy it. Essentially, the premium is the price you pay for the right to buy or sell the underlying asset at the strike price before the expiry date. It's determined by various factors, including the underlying asset's price, the strike price, the time remaining until expiration, and the volatility of the asset. It's important to remember that an options contract doesn't obligate you to buy or sell the asset. It just gives you the right to do so. You can choose to exercise the option and make the trade, or let it expire and walk away, losing only the premium you paid. Just like a cake isn't just flour, sugar, and eggs, an options contract isn't just about buying and selling. It's a complex financial instrument that requires understanding its key components: the strike price, the expiry date, and the premium. These three components are crucial to understand when you're getting into options trading. So make sure you've got a clear grasp on them before you step into the exciting world of options. You might be asking, why should I even trade options? Well, that's a great question. Let's dive into 3 compelling reasons why you might want to consider trading options: hedging, speculation, and leverage. First, let's talk about hedging. You can think of hedging as a form of insurance. It's a strategy that helps protect your investments. When you buy homeowners insurance, for instance, you're hedging against potential damage to your home. Similarly, in the world of investments, options can be used as a hedge against a downturn in the market. This can be particularly useful when you've got a lot of exposure to potential risk. By purchasing options, you can offset potential losses that might be incurred in your other investments. Now, moving on to speculation. This is where the possibility of significant returns comes into play. Speculating in options is all about predicting the future. You speculate that a stock's price will soar, so you buy a call option. If you're right, and the stock price does indeed skyrocket, you stand to make a substantial return on your investment. The potential for high returns is a major draw for those who trade options. Finally, we have leverage. This is where options really shine. Leverage in options trading allows you to control larger amounts of shares for a fraction of the price. For example, buying a single call option contract gives you the right to control 100 shares of stock. This means you can benefit from the price movements of a much larger amount of stock without having to fork out the money to buy all those shares outright. In essence, options trading can be a powerful tool in your investment toolkit. It offers the ability to hedge against risk, speculate on future price movements for potentially significant returns, and leverage your investment to control more shares. Remember, all investment strategies come with their own set of risks, and it's important to understand these before diving in. Options can provide flexibility for investors at every level and help them manage risk. So, why not consider adding options trading to your investment strategy? Like all investments, option trading comes with its own set of risks and rewards. In the vibrant arena of financial markets, option trading is a player that cannot be overlooked. But like any game, there are 2 sides to every coin. The potential for hefty profits is balanced by the risk of significant losses. Let's start with the risks. The most glaring one is the possibility of losing your entire investment. Unlike owning shares of a company, where you possess a tangible piece of the business, options are a bet on the future. If your prediction doesn't pan out, your option could end up worthless. This is especially true for buyers of call options who stand to lose their entire premium if the stock price doesn't rise above the strike price before the option expires. But it's not just the potential for loss that can be daunting. Options can be complex and require a good understanding of financial markets and strategies. Without this knowledge, it's easy to make costly mistakes. Now let's flip the coin and explore the rewards. One of the main attractions of options is their potential for high returns. If the market moves in your favor, the profits can be substantial. For instance, if you buy a call option and the stock price rises significantly, your option could increase in value many times over. Moreover, options allow you to leverage your investment, meaning you can control a large amount of stock for a relatively small amount of money. Options also offer flexibility. They can be used not only to speculate on the direction of a stock's price, but also to generate income and hedge against other investments. This versatility is another reason why many investors are drawn to options. But as we wrap up this discussion, let's circle back to a crucial point. Every reward in option trading is tethered to a risk. It's the nature of the beast. Therefore, it's essential to understand these risks and rewards thoroughly before diving headfirst into the world of options. Always remember, with greater potential reward comes greater risk. So now that we've covered the basics, let's recap. Option trading, at its core, is a form of financial derivative where you, as a trader, have the option but not the obligation to buy or sell a security at a predetermined price before a specific date. It's like getting a VIP pass to a concert. You have the right to attend, but you're not obligated to show up if you don't feel like it. We then delved into the concept of call and put options. Remember, a call option grants you the right to buy a security at a fixed price, while a put option gives you the right to sell. It's like having a reservation at a restaurant. You can choose to dine in or pass the opportunity to someone else. Next, we unpacked the key components of an option contract. An option contract is like a recipe. It has several ingredients that make it what it is: the underlying asset, the strike price, and the expiration date. Each component plays a crucial role in the contract and affects its value. We also discussed why people trade options. Options offer flexibility, leverage, and the ability to hedge against risk. They allow you to speculate on price movements with a limited downside, making them an attractive addition to any savvy investor's toolkit. But remember, with great power comes great responsibility. The potential for high rewards in option trading is accompanied by substantial risks. The key to mitigating these risks is understanding them and making informed decisions, and that's the crux of it. Knowledge is power. The more you understand about option trading, the better equipped you'll be to navigate its complex waters. It's not a get-rich-quick scheme, but a strategic tool that can help you achieve your financial goals when used wisely. Remember, option trading can be a powerful tool in the right hands. But like all tools, it's important to understand how to use it properly. Stay informed, stay smart, and happy trading.